Here is your fully rephrased, clean, and well-structured YouTube script in paragraph form, with improved flow, clarity, and storytelling for better engagement. Let me tell you about something important, something that might actually make you feel better about how you handle your own money, and at the same time, make you less judgmental about how others use theirs. People often do things with money that seem strange, irrational, or even completely crazy. But the truth is no one is actually crazy. Here's why. Every person's financial behavior is shaped by their own life experiences. People come from different generations, are raised by different parents with different incomes and values, live in different parts of the world, and grow up in completely different economic conditions. They experience different job markets, opportunities, and levels of luck. Because of all this, they learn very different lessons about money. Each of us builds our understanding of money based on what we personally go through, and what you experience firsthand is far more powerful than anything you learn from others. That's why all of us, you, me, everyone walk through life with our own unique beliefs about how money works, and those beliefs can vary wildly from person to person. What seems irrational to you might make perfect sense to someone else. For example, someone who grew up in poverty thinks about risk and reward very differently than someone raised in wealth. A person who struggled to survive will never view money the same way as someone who always had financial security. Similarly, someone who lived through high inflation has a completely different mindset compared to someone who grew up in a stable economy. Their fears, decisions, and habits are shaped by those experiences. Think about a stockbroker who lost everything during a financial crash. Their perspective on investing will be completely different from a tech worker who experienced only booming markets and growth. Even geography plays a role. Someone who has never experienced a recession will think differently about money than someone who has lived through multiple economic crises. The list goes on endlessly. Everyone's financial perspective is unique. We know things about money that I don't, and I know things that you don't. We all move through life with different beliefs, goals, and expectations. And that's not because one of us is smarter or better informed. It's simply because we've lived different lives, shaped by different experiences. The challenge is that no amount of reading or studying can fully recreate the emotional impact of real-life experiences. You can read about financial crises, but unless you've lived through one, you don't truly feel the fear, uncertainty, and stress that come with it. Spreadsheets and data can show you how markets behave, but they can't show you what it feels like to look at your family and wonder if your financial decisions will affect their future. That emotional weight cannot be taught, it has to be experienced. We all think we understand how the world works, but in reality, we've only experienced a tiny portion of it, and that small slice shapes most of our beliefs. This is why even highly intelligent people can completely disagree about money. It's not always about knowledge or education. Often, it comes down to when and where you were born, and what you experienced along the way. For example, famous investor Bill Gross once admitted that his success was partly due to being born at the right time. His career aligned with a period when interest rates were falling, which boosted bond prices. To him, bonds looked like powerful wealth-building tools, but to earlier generations who lived through high inflation, bonds felt like a bad investment. Even something as simple as the stock market looks different depending on when you were born. If you grew up during a period of strong market growth, you're more likely to trust and invest in stocks. But if you grew up during stagnant or declining markets, you might avoid them altogether. Research even shows that people's investment decisions are heavily influenced by the economic conditions they experienced early in life. If you lived through high inflation, you may avoid certain investments. If you grew up during strong markets, you may take more risks later on. This means our financial decisions are not just based on logic, they're deeply influenced by personal history. Because of this, no two people will see money the same way. No two people will agree on what's worth it, what's risky, or what the future holds, and no one should expect them to. A decision that seems unreasonable to one person might be completely logical to another. Take something like lottery tickets. Many people think it's foolish, especially when low-income individuals spend money on them instead of saving. But if you try to understand their situation, it starts to make sense. For someone living paycheck to paycheck, with limited opportunities and no clear path to financial growth, a lottery ticket represents something powerful, a chance, however small, to dream. It's not just about money, it's about hope. You may not agree with that decision. It may still be financially unwise, but you can begin to understand why it happens. And that idea, this seems crazy, but I understand why, explains a lot of financial behavior. The truth is, very few people make financial decisions using pure logic or spreadsheets. Most decisions are made in real life at the dinner table, in conversations, influenced by emotions, past experiences, social pressure, and personal beliefs. Another important thing to understand is how new modern finance really is. Money itself has existed for thousands of years, but the way we think about saving, investing, and retirement is relatively new. For most of history, people worked until they died. Retirement, as we know it today, is a modern concept. Systems like pensions and Social Security only became widespread in the last couple of generations. This means we are all still learning. We're all navigating a system that is still evolving. And that's why money can feel so confusing and why people behave the way they do. There's a common belief that in the past, everyone had a private pension waiting for them after retirement. But the truth is, that idea is greatly exaggerated. Research shows that even in 1975, only about a quarter of people over the age of 65 actually received any pension income. And even among those who did, pensions made up only a small portion of their total income. Back in 1955, even newspapers were highlighting this issue. There was a growing desire for retirement, but very few people were actually able to achieve it. It was almost like an old saying: everyone talked about retirement, but hardly anyone truly prepared for it. It wasn't until the 1980s that the idea of a comfortable and dignified retirement became widely accepted, and along with that came a new expectation that individuals themselves would be responsible for saving and investing for their future. What's important to understand is just how new this concept really is. The 401k, which is now one of the most common retirement savings tools, didn't even exist until 1978. The Roth IRA came much later, in 1998. If these systems were people, they would barely be old enough to be considered mature. So it shouldn't be surprising that many of us struggle with saving and investing for retirement. It's not because we're careless or irrational, we're simply still learning. In many ways, we're beginners navigating a system that hasn't been around long enough for generations of experience to develop. The same pattern can be seen in education. Over time, the number of people earning college degrees has increased dramatically, but along with that, the cost of education has also skyrocketed. This rapid change explains why so many people have made poor decisions with student loans in recent years. There simply isn't enough long-term experience for people to fully understand the consequences. The story is similar with investing tools. Index funds, which are now widely recommended, have only been around for a few decades. Hedge funds became popular even more recently, and the widespread use of consumer debt, things like mortgages, credit cards, and car loans, only became common after World War II. When you look at it this way, the modern financial system is still very young. To put it into perspective, dogs were domesticated over 10,000 years ago, and they still carry some behaviors from their wild ancestors. Yet here we are, trying to fully adapt to a financial system that has only existed in its current form for a few decades. For something that is so heavily influenced by emotions, this creates a real challenge. It helps explain why we don't always make perfect decisions with money. The truth is, we all do things with money that might seem irrational, but that's not because we're crazy. It's because we're all relatively new to this system, and we're making decisions based on our own experiences, knowledge, and circumstances. What looks irrational to you might make perfect sense to someone else. And that's the key idea: no one is truly crazy when it comes to money. Everyone is simply doing the best they can with what they know and what they've experienced. Now, with that in mind, let me tell you a story about how Bill Gates became rich.